Welcome to OLevels Business Studies Unit 23, Cash Flow Forecasting and Working Capital. Cash is a liquid asset immediately available for spending on goods and services. Without adequate cash, businesses may struggle to pay employees, suppliers, landlords, or the government. This shortage can halt production, disrupt operations, and force liquidation, requiring the sale of assets to cover debts. Cash flow refers to the movement of money in and out of a business over a period. Maintaining a healthy cash flow is crucial for meeting financial obligations and sustaining operations. Cash inflows occur through product sales, payments from debtors, bank loans, asset sales, and investments from stakeholders or shareholders. Cash outflows include purchasing raw materials, paying wages, investing in fixed assets, repaying loans, and settling payments with suppliers and creditors. Effective management of cash inflows and outflows is vital to prevent liquidity issues and ensure business operations run smoothly. The cash flow cycle shows how cash moves through business operations. It begins with cash needed for materials, wages, and rent. After production, products are sold. Credit sales can delay payments, affecting reinvestment in production. Timely payments sustain the cycle, while delays cause cash shortages, highlighting the need for careful planning and monitoring. Differentiating cash flow from profit is crucial. Cash flow tracks money movement in and out of a business, while profit is the surplus after deducting costs from revenue. Profitable businesses can face cash shortages due to extended customer credit, large investments in non-current assets, or rapid expansion without sufficient reserves. These issues can lead to insolvency, preventing a business from meeting financial obligations despite appearing profitable. Cash is essential for business operations. Without enough cash to pay bills and repay loans, a business may cease operations. Business managers must understand their available cash monthly. A cash flow forecast estimates future inflows and outflows, helping managers plan. A cash flow forecast begins with inflows, followed by outflows. Net cash flow is calculated by subtracting outflows from inflows. This amount is added to the opening bank balance, representing cash at the start of the month to determine the closing balance at the end of the month. The closing balance becomes the next month's opening balance. A positive net cash flow increases the closing balance, while a negative one reduces it. Cash flow forecasts provide insights into available cash for paying bills, repaying loans, or purchasing fixed assets. They also indicate if additional loans are needed to avoid insolvency, or if excess cash could be invested more profitably. Cash flow forecasts are useful when starting a business, managing operations, informing banks, and maintaining cash flow. Startups must estimate cash needed for initial expenses like premises, machinery, inventory, and marketing. A cash flow forecast ensures these costs are covered and the business remains sustainable in its early stages. Banks require cash flow forecasts before granting loans to assess financial health and determine loan amounts and timing. Lenders rarely approve loans without a clear forecast, as it provides transparency on financial stability and repayment ability. Existing businesses, regardless of success, need forecasts to manage expenses and avoid financial shortfalls. Purchasing expensive fixed assets may require an overdraft or loan, and proper planning helps secure favorable interest rates. Without planning, businesses may face higher interest costs or loan rejections. Effective cash flow management prevents excessive cash holdings, which could be better used for expansion or investment. Businesses with high bank balances should consider paying off loans to reduce interest costs or paying suppliers early to receive discounts. Proper cash flow management ensures financial stability and competitiveness. Businesses can address short-term cash flow issues through several methods, each with potential limitations. Increasing bank loans provides immediate cash, but incurs interest costs and future repayment obligations. Delaying payments to suppliers temporarily reduces cash outflows, but may lead to supply disruptions or late payment fees. Encouraging quicker debtor payments or insisting on cash sales boosts short-term cash inflows, but may drive customers away if they prefer credit terms. Delaying or cancelling capital equipment purchases reduces cash outflows, but can hinder long-term efficiency if equipment becomes outdated or unavailable. Businesses facing long-term cash flow issues should consider strategic solutions such as attracting investors by selling shares, which may affect ownership control, cutting costs and improving efficiency, which could impact employee morale, and investing in new products, which requires upfront cash and time to yield returns. Working capital is the capital available for daily operations, calculated as the difference between current assets and liabilities. Sufficient working capital is essential for maintaining creditworthiness and seizing opportunities, such as purchasing raw materials at a discount or fulfilling special orders. Cash is needed to cover operational costs and inventory purchases. As sales increase, additional credit may be required to support higher debtor values. Managing inventory is crucial. Insufficient inventory can halt production, while excess inventory increases opportunity costs. A business's success depends on its working capital position. Effective management reflects financial health and operational efficiency, ensuring sustainability and growth. Thanks for watching. Make sure to like, share, and subscribe for further content.